Hello and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Hello, Michelle. How are you?
Hi, Wendy. I'm good. How are you?
I'm good. I was good, but now I think we're going to be talking about taxes today.
Our favorite topic.
Oh,
yes.
Yes.
Your favorite topic, right?
Isn't it everybody's?
Well, even if it's not your favorite topic, you have to know a little bit so that you can use the advantages that are there for you if you only knew about them.
Okay. So, these are things that we should keep in mind so that we can get the best tax advantages possible.
That's right. That's right. Education is key. They say ignorance is bliss, and I understand that, but it's not bliss when it comes to taxes, okay?
Mm-hmm.
So here we are. So episode 29, I believe, is where we are. And there is another couple of episodes I'm going to cross-reference here because I talk about taxes a lot. And so if you are interested in this topic, please feel free to browse through some of the other episodes we have on the favorite subject of taxes.
Right.
All right. So what I'd like to do, I want to cover about 5 tax rules and about 2 tax strategies. Traps and tips are the key words that I'm thinking of. A little bit of traps that you want to be aware of and a few tips that you should avail yourself of if you can. Mm-hmm. So the first one I want to talk about today is Medicare IRMAA. Now, if you are not yet on Medicare, you're probably thinking, oh, great, that doesn't apply to me. But it actually could apply to you. You just don't know it yet. So if you are 2 years away from turning 65, you really do need to pay attention. And you should get educated prior to having this particular tax issue come upon you. So today we're going to talk a little bit about Medicare IRMAA. What is IRMAA? IRMAA is an abbreviation that stands for Income-Related Monthly Adjustment Amount. And it's a mouthful, so we don't say it. We just say IRMAA. And what is Medicare IRMAA? It is a surcharge that you can get slapped with when you start taking Medicare. So everybody knows that Medicare has a premium, just like every other insurance benefit. And the premium is set at a base rate for everybody. But if your modified adjusted gross income exceeds a certain income threshold, then you get hit with this Medicare IRMAA for the entire year. So this threshold is set by Medicare, and they apply it to your income from 2 years prior. So each year it resets and it looks at what was your income 2 years ago, and that's what determines this surcharge or no surcharge.
Okay.
Why are they going something, Wendy?
By 2 years? That's what's a little curious to me.
Why does the government do anything that it does, Wendy? That's a really good question. Nobody knows the answer to that. Maybe it takes them that long to sift through the data. I don't know.
Okay. So this is adjusted every 2 years, you're saying, depending on your income.
It's adjusted every year, depending on your income, using the tax return from 2 years ago.
Gotcha. Okay. All right.
Yeah. So how do you avoid Medicare IRMAA? Well, sometimes you just can't. Sometimes your income is high enough, according to their thresholds, which are readjusted every year, to trigger this thing. Now, if you are close to a Medicare IRMAA threshold, that's where we come in, because a good advisor who does tax planning will help you to see how close you are, because we're doing tax planning long before the tax return is filed to see what you can do before the tax year is over with. So maybe there's something that you can do to not get close to that IRMAA, because $1 over the IRMAA triggers the surcharge for the full year.
Okay.
And they'll look again, so it's not like forever, but still, nobody wants to pay more premium than they need to.
No, thank you.
So, all right. And by the way, if you just retired, let's say, you made a bunch of money, you retired, now you don't make that money anymore. So you'll get hit by the IRMAA from the 2 years ago where you were, weren't retired. But that is a legitimate reason to appeal to have that IRMAA surcharge removed. Yes, you can appeal. You can use a form called SSA-44, and you can appeal it, and you should appeal it because retirement is one of the legitimate reasons to have that decision overturned. But if you don't appeal it, that's what you're going to get hit with. By the same token, a Roth conversion is going to increase your income, and at least for that year. That is not an appealable reason. You can't say, "Oh, well, it was just a Roth conversion, so don't hit me with this IRMAA." Well, that's not an appealable, legitimate reason, but retiring is.
So what basis do they use then if you appeal and win?
So there are certain reasons that they allow as a reason to appeal the decision. And I don't have them memorized, but I do know that retirement is one of them. I don't know if I answered your question.
I'm just saying that if they're not using the income from 2 years ago, what are they using?
No, they are using the income from 2 years ago. But if your income was high 2 years ago compared to where you are now, because now you're retired,
okay,
they'll say, "Oh, okay, yeah, you're retired. Yeah, they didn't know that." So they'll make you turn in a couple of things to prove that you were not retired, but you are now. And then they'll remove you from that surcharge.
Gotcha.
All right. So moving on to our next tax trap or tip is short-term or long-term capital losses. So what is a short-term or long-term capital loss? Well, a capital loss is when you've sold something and what you received is less than what you paid for it, right? So that's a capital loss. When you sell something, let's just say it's stock or it's property, whatever it is, that loss is capped at $3,000 to use on your tax return against ordinary income. You can't use more than that. So let's say you have a $50,000 loss. Well, you can only use $3,000 of that to offset ordinary income on your tax return. And the rest of it is carried over to future tax years that you, again, $3,000 a year, all you can use for ordinary income, unless you have a capital gain to match against the capital loss. You can use an unlimited amount of capital loss against capital gain. So what's a capital gain? You sold something, you made money. You're going to be taxed on that. So if you have enough loss to offset a gain, great, then great, use it. But that excess loss beyond what you have to match with for capital gains, you can only use $3,000 of that on your tax return for ordinary income reduction to be taxed.
So if it's $50,000 and there's only $3,000 a year, how many years can I take it for?
They used to have a limit, but there is no limit as far as I know.
So I can do it for the rest of my life?
Only $3,000
okay,
for the rest of
year,
your life.
Yep.
Unless maybe you have a year where you have a capital gain. Maybe you sold your house and there's a capital gain. You can use the capital losses that you've carried over. So again, capital loss offsets capital gains, except for $3,000, which you can put against ordinary income, and just that. Here's the thing I don't like. That limit of $3,000 was set in 1978, and it has never been increased. Not good, right? And there's a few of those like that. So yeah, that's kind of a little bit of a trap as far as I'm concerned, but that's the way it is. Again, a good advisor who's doing tax planning like our office is going to be looking out for this kind of stuff so we can help you use what you have. And, maybe there's a benefit. Maybe there's something that we can do on the investment side to raise a capital loss for you to help you offset some ordinary income. And that's tax loss harvesting, which I won't get into, but that's what that's about.
Okay. That sounds very involved, so I'm not going to ask anything.
It can be. Now, Social Security tax. That's a topic where I did a whole episode 23. And so if you have more interest in this particular topic, feel free to go and listen to that episode. I'm not going to go into a bunch of detail, but what I am going to bring up here today is that there is a Social Security tax. And it is based, once again, on a bunch of thresholds set by the government. In this case, it's provisional income, which has its own definition. It's not modified adjusted gross income. It's not adjusted gross income. It is literally called provisional income, and it's constructed of certain items. So I'm not going to go into that here because I did on episode 23, which you can take a listen to if you want. What I will say here is that these thresholds set for this Social Security tax have not changed for years. So originally, you may or may not know that Social Security benefits were not taxed at all. But beginning in 1983, that was a good year, by the way, but 1983, they created the 50% provisional income threshold. And that is $32,000 for people that are married filing jointly and only $25,000 for singles. And they have not changed it. So what that means is 50% of your Social Security benefits will be taxed if you exceed that income threshold. And then in 1993, they created the 85% threshold. Before that year, only 50% of your benefits could be taxed. But now up to 85% of your benefits can now be taxed as of 1993. And again, these income thresholds have not kept up with inflation. They've never been adjusted. Why do you need to know this? Because if you understand how your Social Security benefits are taxed, there could be a way to lower how much of your benefits are taxed or even possibly eliminate the taxation on your benefits. A lot more to say here, but I'm not going to go into it on this episode. However, I did in episode 23, so please feel free to check that out.
Okay.
All right, how you doing, Wendy, with all this tax talk?
It's depressing, Michelle, to tell you the truth.
But don't you feel educated to know about some of this stuff?
You know, ignorance is bliss, Michelle. No, I'm just kidding.
It can be. It can be. All right. Well, we're going to keep going. I've only got a couple more left. So are you ready for net investment income tax?
Okay.
Now, net investment income tax is a mouthful. So it's abbreviated NIIT, NIIT, and some people call it the NIIT tax. All right. So that's what they're talking about. Now, this gets assessed when your income reaches a certain level again, right? So we have more income thresholds. Dividends, rental income, capital gains, that type of thing, those are subject to an extra 3.8% tax if your adjusted gross income as a married couple exceeds $250,000 for the year, or if you're a single filer, it exceeds $200,000 for the year. Now, once again, this threshold has not been adjusted for inflation since it was created in 2013. Here's what I want to stop and say for a second. $200,000 for singles and $250,000 for marrieds. Do you think that's fair, Wendy, for the married folk?
No, it should be $400 for married folk.
You would think so, right?
Right.
It's what I call the marriage penalty. Now, we could make a joke about marriage penalties, but we're not going to go there. So the NIIT tax, is a little bit of a marriage penalty because you're right. It should be twice as much for two people, but it's not. So what can you do about it? Once again, if you're doing forward-thinking tax planning, which most CPAs are not going to do, they're going to look back at your tax return, tell you what you owe, tell you what happened, but they're not going to be looking forward. Our office looks forward. We're doing tax projections for the year right now, earlier in the year, so that there's time for you to do something about it before it's over with. So let's say you're close to that NIIT threshold. Maybe there's something that you can do, like maybe you switch your contributions if you're still working from the Roth 401k to the regular 401k so you can lower your taxable income. There's some other things too. In some cases, though, it's not really a tax to worry about. If you don't have a lot of dividends or interest or capital gains, rental income, all that, maybe your NIIT tax is really going to end up being just, a few bucks. So I don't want people to stress out, but you just need to know how it works.
Okay.
All right. So the next tax tip or trap or however you want to think about it, is the QCDs, which stands for Qualified Charitable Distributions. I do believe I've talked about this before. What I want to remind you is if you are giving to charity and you're not using a donor advised fund and you're 70 and a half or older, you should be using this strategy. If you're not planning to give to charity, then don't use the strategy because it only really makes sense if you were going to give to charity anyway. So what does this strategy do? It literally lowers your taxable income while you're allowed to take the standard deduction. So I don't know if you are aware, but if you take the standard deduction, well, now you can't itemize, right? If you're giving to charity, then and you're taking the standard deduction, you wouldn't get any benefit from giving to charity on your tax return. But the QCD changes that. It says you can take the standard deduction and we're still going to give you a benefit for your charitable distribution, because what they're going to do is lower your adjusted gross income, or actually modified adjusted gross income, dollar for dollar if you're giving to a qualified charity and you follow all the rules of the QCD. Now, that's better than a deduction, because if you lower your above the line, modified adjusted gross income, now that's good for your Medicare premiums, right? Because we just talked about how we want modified adjusted gross income to be lower so you don't trigger IRMAA. So this is good. If you're 70 and a half, you're going to be given to charity anyway. You have an IRA because it has to come from IRA money. You should be using this, and your advisor should be doing all the heavy lifting, the paperwork. We don't make our clients, worry about how to get this submitted. This is done by your advisor. So another just quick rule I want to give on this topic is that, okay, I said you have to be 70 and a half. So if you're not, you don't get to use this strategy. It has to be the first distribution of the year. So you can't have already taken from your IRA and then do a QCD. It has to be first in line. And you can't do more. You can't give more than $108,000 in 2025. So anything up to that amount could be helpful for you if you follow the rules and there's paperwork and I just want to point out you should be looking into it.
Okay. I hope I have enough money to donate $108,000.
Now, I just want to clarify, that's the limit. You could donate $50.
Right.
You could donate it's just saying you can't do more than that, but you could do a lot less than that.
Right.
So, yeah. So, okay. Continuing on. I think this is no, it's not the last one, but we're getting close. Underpayment tax penalties. Now, this one I really want to shine a light on because people I have found don't really understand this. They don't know anything about it. So I just want to do a little education here. You can avoid a tax penalty by following what's called the safe harbor amount. What is the safe harbor amount? Well, that's the amount of tax you should be paying at least that keeps you safe from a so-called tax penalty. And what is it? Well, it's 110% of last year's tax obligation if your adjusted gross income was over $150,000 as a married filing jointly filer, or it's $100,000. I'm sorry, 100% of last year's tax obligation if your AGI was 150,000 or actually less than 150,000. Mm-hmm. So again, we're looking at everything's about modified adjusted gross income or adjusted gross income. Have you noticed that? Or provisional income. So they're looking at your income. And if your income is under a certain amount, well, then just pay what you paid last year in taxes. Make sure you've paid that for the whole year. And now you won't have to worry about a tax penalty. That's safe harbor. That being said, there is, there's always but, right? It's like, oh yeah, but. Okay, so yes, but if you are not spreading your tax that you're paying evenly throughout the year, the government does not like that. So you're supposed to be paying your taxes throughout the year. And if you're working, that's why your tax is withheld from your paycheck every time you're paid. And this way you're paying throughout the year. But when you're retired, that's not happening, right? You don't have an earned income. So you might have to do estimated tax payments. Just understand that even if you pay the safe harbor amount, following the rules I just gave, you could have a timing tax penalty if you paid the minimum amount of tax, but you didn't spread the tax payments evenly throughout the quarters of the tax year. So if you're taking distributions monthly, you can avoid this by paying your taxes through tax withholding on those distributions, because that's viewed as equally distributed throughout the year. If you didn't take any tax from your monthly distributions and you pay it all in one lump sum at the end of the year, even if you made the safe harbor amount that we talked about, you didn't follow the timing requirement, so you might get a tax penalty. But just understand that some of these tax penalties that I'm talking about can be quite small. So I'm not trying to alarm anybody, because it may not work out where you can, and you'll see a few dollars of tax penalty in your next tax return. Just want to add, if you're taking the benefits from Social Security, they don't require you take tax withholding out of your benefit. So maybe avoid this timing penalty by having tax withheld from your Social Security benefits. Now, if you're doing a Roth conversion, that's usually done in one lump sum, usually towards the end of the year. And if you do that, you don't know what you're going to do until the end of the year, right? You haven't maybe anticipated exactly what you're going to do for a Roth conversion. So it's really hard to you can't really avoid this timing tax penalty with the example I just gave with a Roth conversion. But again, it's probably just a small amount, so you don't want to just worry about it. I have seen clients where they get a small tax penalty every year because they just cannot spread that tax throughout the year. They can pay the tax that the Roth conversion triggers in the quarter that it happened, but again, it's not spread out throughout the year, so there you have it. Now you understand how safe harbor works.
Mm-hmm.
All right, Wendy. Don't fall asleep on me. I know this is
I'm not. I'm just thinking, I'm thinking mean things about the system.
Yeah. I mean, the system is the system, and it's the system that we have. It's understanding the system so that you can do your best. And if you don't know the system, you don't understand the rules, you can't do your best. And that's what this episode is about. It's just educating you so that you can make good decisions.
Okay.
You can't get away from paying tax, right? You can't get away from death, and you can't get away from taxes.
That's it. There are only two things.
All right. We can do everything we can to stay healthy, to prolong the event of death, and to understand the tax code as best as we can and take advantage of the strategies available to us. But we can't eliminate tax. So just kind of stating the obvious there, but
Yes.
So lastly, what I want to talk about today is the rule of 55. So this came up the other day in one of my meetings with one of my clients. If you want to retire early, so first of all, before I get started, have you heard of the rule of 55?
No,
All
I
right.
haven't.
I have good news for you, Wendy.
Okay.
Did you know that you can take money out of your 401k and pay no 10% tax penalty if you follow the rule of 55?
Okay. I'm intrigued.
All right. Yeah. So what is the rule of 55 that says, hey, if you want to retire early before 59 and a half and you've saved up enough money to do so, and it's in your pre-tax 401k, then you can be or not be subjected to the typical 10% tax penalty if you withdraw your money from that 401k and separate from service in the same calendar year that you turn age 55 or older. So that means you can retire at 55 and not have a 10% tax penalty if you follow those rules.
Okay, but you have to retire to get that money.
You have to separate from service.
Yes.
Yep.
Okay.
And the separation could be for any reason. It could be for retirement. It could be because you got fired. It could be you quit. Whatever your reason is, it doesn't matter.
Okay.
You just have to follow those rules. You separated from service in the same calendar year that you turned age 55 or older, and the money has to be housed in a 401k, and it can't be an old 401k. It has to be the most recent 401k. And of course, you have to have enough money to be able to retire, right?
Mm-hmm.
Let's not forget to say that. So if you have enough money in your 401k, your most recently active 401k, to cover your lifestyle expenses between ages 55 or whenever you retire and 59 and a half, it has to stay in the 401k. You can't roll it over into an IRA. And you won't have that 10% tax penalty, but you will still be subject to ordinary income tax. You can't get away from that. And that ordinary income tax will be applied to every withdrawal, just not the 10% tax penalty that would normally be applied because you're not yet 59 and a half.
Right. Okay.
So now you can get another job and keep working in another workplace savings account or savings plan. And you can still take those withdrawals from that other 401k up until you're 59 and a half. Well, you can do it past 59 and a half, but it doesn't matter anymore because the 10% tax penalty will not have applied anyway. So the important piece here is that money, if you don't want that 10% tax penalty to apply, has to stay in that former employer's 401k. You can't roll it out. You can roll other money out, but not the amount that you want to withdraw from and not have a 10% tax penalty. So I hope I explained that well. It's a little complicated, but it's good news for people who want to retire early and just don't want that tax penalty.
Yeah. I just still, again, wondering why we do what we do. What is required is required. But it's not up to me.
Who comes up with these rules? Is that what your question is?
Yeah.
I don't know. And they seem to get more and more complicated over the years. So for people who do tax returns and tax planning, I feel like we're always going to have job security.
Yes.
Because it is and every time you get your head around it and you feel like you understand it, then they change something.
Exactly.
Yeah. So it's a never-ending job. Mm-hmm. But those are your tax tips and traps to keep aware of, understand, and try to benefit from what you know.
All right. Sounds good, Michelle. We appreciate that. And if people have some additional questions, how would they go about getting in touch with you?
Yeah. So you can just visit our website, GessnerWealthStrategies.com. All of our contact information is there, our phone number, etc. Reach out. I am happy to help.
All right. Well, thank you so much. And thank you for joining us today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to Retire to a Life You Love with Michelle Gessner from Gessner Wealth Strategies. We hope you were inspired to take steps to your financial freedom as you learned new techniques and strategies for managing your finances. To learn more about how you can improve your financial landscape, visit our website at www.GessnerWealthStrategies.com. That's GESSNER wealthstrategies.com. Or give Michelle and her team a call at 713-589-6448. And don't forget to click the follow button below to be notified when new episodes are available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Michelle Gessner or Gessner Wealth Strategies. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.